Okay, so Dell just posted their numbers, and apparently the new AI bottleneck is not even GPUs anymore. It is basic memory, because customers are literally panic buying traditional servers just to stay ahead of component inflation.
Welcome to Earnings Unscripted, where we translate the noise of earnings season into actual signal. Today, we are unpacking Dell, ticker DELL, for their first quarter of fiscal 2027. Today is May 28th, 2026. And Miro, this top-line growth is just completely untethered from their costs right now.
It is. It is structurally fascinating because they grew top-line revenue to $43.8 billion, which is up 88% year over year, but their total operating expenses only grew 9%. I mean, they drove their OpEx ratio down to 8.4%, giving them their best operational efficiency in over 2 decades.
Okay, a 20-year low on expenses while nearly doubling revenue is absurd. Quick sanity check, though, before we dive deeper into these billions. Just a reminder that this show is strictly our personal opinions and definitely not financial advice. But seriously, Mira, the tape on this stock is doing things a hardware giant is just not supposed to do.
No, it is trading like a software startup right now. The stock was already up roughly 82% heading into earnings over the last quarter. Regular trading today was practically flat, but the second the bell rang, the after-hours action just went parabolic. It spiked from around 317 to peak just under 444, closing the extended session at 441. That is an enormous 44% primary earnings reaction.
I mean, jumping 44% after climbing steadily all quarter is just staggering. And I guess seeing non-GAAP EPS come in at 486 does a lot of the heavy lifting. Plus, they printed over $4.2 billion in non-GAAP operating income. But it feels like this is more than just the usual AI hype cycle.
Right. The hype actually has hardware attached to it now. They recognize $16.1 billion just in AI server revenue. But the part that actually surprised me, the traditional legacy servers, the boring boxes everyone said were dead, they grew 92% year over year to $8.5 billion. Wait, back up. Why are legacy servers suddenly spiking? Because literally all we hear about is AI completely cannibalizing traditional IT budgets?
I know, we all assumed that. But Jeff Clark laid it out perfectly. We are moving into agentic AI. The models are not just answering questions anymore. They are taking actions. And to execute those complex sequential actions, the AI essentially needs a logic harness. And that harness has to run on a traditional CPU.
That makes so much sense. It is like the AI is the engine, but you still need the CPU to actually steer the car. So the AI wave is pulling legacy compute back from the dead.
Precisely. But here's the problem. Building all of this requires physical parts. Dell is sitting on a record $51.3 billion AI backlog, and they literally cannot fulfill it right now because supply constraints have shifted. The pain point is no longer just NVIDIA chips. It is DRAM, NAND, and CPUs.
Which brings us right back to that panic buying. People know inflation is hitting those memory components hard, so they're ordering early. And I noticed Dell aggressively hiked PC prices this quarter, trying to outrun that same inflation. But the CEO basically admitted they moved too early and accidentally chilled their own consumer demand.
Yeah, you hike prices ahead of the market, you freeze the buyer. It's a classic misstep.
All right, let's actually dig into the details on that, because managing a $50 billion infrastructure backlog while your PC strategy hits an inflation wall is a wild corporate dynamic. Let's get into the deep dive and see how this cost tension is actually playing out.
It really is wild, because if you just look at the surface, Wall Street usually punishes a company when their gross margin rate falls. And Dell's overall margin rate actually dropped this quarter, down to 18.1%.
Right, except that is entirely driven by the product mix shift. You are selling these massive AI-optimized servers where the underlying NVIDIA component costs eat up a huge chunk of the final ticket price.
Exactly. The percentage gets heavily diluted by the AI hardware, but the absolute volume is so violently high that nobody cares about the rate. I mean, non-GAAP operating income still exploded past $4.2 billion. It is the classic margin illusion. You make less margin per individual dollar, but you bring in so many new dollars that it just completely buries the difference.
It definitely buries it. And, those dollars are not just coming from the computing side. Jeff Clark had this genuinely great visual on the earnings call. He talked about unstructured data being the fuel that I think his exact words were feeds the beast in AI.
Yeah, preparing that data requires a ridiculous amount of space.
Right. To actually feed that beast, you have to store the data somewhere accessible. So Dell essentially had to invent what they're calling exascale storage just to handle the volume.
Well, yes, because AI data indexing is just unbelievably dense. I looked at the specs on their new PowerStore Elite. They claim it has a 6-to-1 data reduction. So a customer buys 1 petabyte of raw physical storage, but they can compress and hold 6 petabytes of actual data on it. And Dell says it reads 70% faster.
That just sounds like literal magic. Buy one, get 6 free. But I love that because it grounds all this abstract AI cloud theory into something tangible. It brings the conversation right back down to heavy, extremely expensive metal sitting in a data center.
It does, but that heavy metal is going to a very concentrated group of buyers. Let me rephrase that better. That is exactly where the structural risk lives. If you dig into their annual filings from last year, there's this quiet little note. A single infrastructure customer accounted for 12% of their entire consolidated revenue.
Jeez, that is over $13 billion from one single buyer?
Roughly $13.6 billion, yeah. The AI server revenue is incredible, but it is heavily tethered to a tight cluster of legacy hyperscalers and these specialized new GPU providers they call neoclouds. If just one of those major buyers pauses to digest their capacity, that entire margin illusion starts to unwind very fast.
That is such a fascinating split personality for the company. On one hand, you have this elite group of corporate neoclouds panic ordering $50 billion of servers. And then on the PC side, like we mentioned earlier, they accidentally froze out normal small businesses and everyday consumers just by raising laptop prices a little too early.
Completely different economic realities operating under the exact same ticker symbol. And while the AI infrastructure side is booming, it is actively covering up other leaks. Their corporate and other segment revenue is actually dropping fast because they completely terminated their commercial resale framework with VMware back in March.
The fallout from the Broadcom acquisition.
Exactly. Dell used to pull in very reliable software distribution revenue from that relationship, and now it is basically gone. So this AI tidal wave makes for a fantastic headline, but it is undeniably hiding a few jagged rocks under the surface.
Always is. So you have dropping margin rates offset by sheer volume, extreme buyer concentration, and this massive $50 billion hardware backlog that customers might just be hoarding out of inflation fears. So where does this actually leave them heading into the rest of the year?
Look, stepping back from all the hardware mechanics, I think the real story is just how dangerously confident management is right now. I mean, they raised their full-year revenue guide by $10 billion, and this is only 90 days into the fiscal year.
Wow, $10 billion? That is, that is not just tweaking a spreadsheet. That is planting a massive flag.
Exactly. They pushed the full-year target to roughly $167 billion at the midpoint. And David Kennedy, the CFO, practically came out and said the demand is bottomless. He had this line where he said, if you look at their pipeline over the next 5 quarters, it is, quote, multiples of their backlog.
Wait, multiples? Because if the current backlog is $51 billion, they are implying a forward pipeline of what? $150 billion? 200? That actually sounds terrifying.
It is terrifying if you cannot source the parts. They are explicitly projecting $60 billion just in AI server revenue this year alone. But, and here's the tension we discussed, we still do not know how much of that pipeline is durable demand versus customers double ordering just because they're terrified of inflation.
Right, exactly. Is it real long-term growth or is it just enterprise hoarding? And on the flip side, you have the PC business. Jeff Clark fully admitted they miscalculated those price hikes, and he said that's going to be reflected in their go-forward margins, which I think they only expect low teens growth for the client side now.
Yeah. That's soft, because if corporate IT budgets are getting completely drained just to pay for these massive exascale AI racks, there might not be any cash left to refresh standard office laptops.
It feels like the infrastructure side has to run perfectly just to subsidize the traditional business.
So we're essentially watching one of the biggest hardware booms in history trying to outrun its own supply chain. Fascinating dynamic to track. I guess we'll see how many of those servers they actually manage to build by next quarter.
Assuming they can find the memory components. If not, I imagine their procurement team is not sleeping much these days.
Definitely not. All right, that feels like a solid place to pause. Always fun unpacking these, Mira.
Always. We'll see how it plays out.
Catch you all after the next call. Bye, everyone. So if you want these earnings conversations to just automatically show up in your feed, hitting follow is the easiest way to do that. As a quick transparency note, we do use AI to help generate this show, which is really how we managed to turn an episode around just hours after the numbers drop. We genuinely love getting your feedback and ticker requests, so feel free to email us at earningsunscripted@datamadness.ca or grab the X link in the show notes.
Talk to you soon.